A $10,000 credit limit increase isn't a reward. It's a calculated move to keep you working 3 extra years before you can retire. While everyone else is celebrating their higher score, I'm going to show you why that boost is actually an invisible leash designed by banks to ensure you never reach a zero balance. Here is the math they hope you never calculate. You probably remember the feeling, that little notification. Congratulations, your credit limit has increased. It feels like a compliment, like the bank looked at your life and said, "You're doing well, here's a reward." But nobody ever asks the second question, the one that actually matters. Why would a company that exists to make money hand you more borrowing power for free? Companies don't give things away. Not really. Somewhere in that decision is a calculation, and that calculation was never about you winning. So today I want to walk through what's actually happening behind that notification. Not with outrage, not with panic, just with the math. Because once you see the numbers the way the bank sees them, that little green increase available button starts to look very different. Here's where most people go wrong when they think about debt. They assume it's a personal failure. Too many purchases, not enough discipline, a budget that fell apart in December. And sure, individual choices matter. Nobody's pretending they don't. But zoom out for a second. Millions of people from wildly different backgrounds with wildly different levels of self-control somehow end up in remarkably similar financial patterns. Rising balances, minimum payments that never seem to move the number down, a sense that they're treading water no matter how hard they swim. When that many different people hit that same wall, it's worth asking whether the wall was built on purpose. It was. Not by any single villain twirling a mustache in a boardroom. It's quieter than that. It's built into the architecture of the product itself. The credit limit, the minimum payment formula, the timing of the offers. None of it is random. All of it is tested, modeled, and optimized. And the goal of that optimization was never your financial freedom. It was your engagement with the product. Those are two very different things that happen to look similar on the surface. Let's start with the moment the limit goes up. There's a reason banks tend to raise limits during periods when the cost of living is climbing. On the surface, it looks generous. Inflation is squeezing you, so here's some breathing room. In practice, it does something else entirely. It quietly resets your internal ceiling. Before the increase, your brain had a rough mental line. This is what I can spend. After the increase, that line moves, even if your actual income hasn't moved an inch. This is the part almost nobody talks about. Available credit doesn't just sit there as a safety net. It gets processed by your brain as a kind of phantom wealth. Not real money, but something that feels like permission. Think about the last time you saw a higher available balance on your banking app. There's a small, almost imperceptible lift, a little dopamine flicker. It's the same mechanism that makes a full tank of gas feel like abundance, even though you paid for every drop of it. The number is bigger, so the feeling is bigger, even though nothing about your actual purchasing power, your income, your savings, your ability to pay things back has changed at all. And that's the shift that matters most. Your spending decisions stop being anchored to what can I afford and start drifting toward what can I borrow. Those two questions produce wildly different answers, and only one of them keeps you financially stable. Now here's where the design gets genuinely clever. And I mean that in the most literal sense. This is engineered. Minimum payments are typically calculated as a small percentage of your balance, often somewhere around 1 to 3%, plus interest and fees. On paper, that sounds harmless. In practice, it's built so that even as your balance grows, the minimum payment barely grows with it, while the interest portion of that payment stays dominant. Picture two people. One has a $5,000 balance. One has a $15,000 balance after a limit increase and some lifestyle creep. If both are paying close to the minimum, the second person isn't paying 3 times as much toward actual debt reduction. They're mostly paying more interest because the loan is bigger, and the formula is designed to keep interest ahead of principal for as long as mathematically possible. This is why so many people describe debt as a treadmill. You're moving, payments are going out every month, the little checkbox says paid, and yet the number barely shrinks. That's not an accident of bad luck. That's the minimum payment formula doing exactly the job it was built to do. Extend repayment timelines while keeping the account technically in good standing. Then there's the 30% utilization guideline. You've probably heard it. Keep your balance under 30% of your limit to protect your credit score. It's not bad advice on its own. But notice what a limit increase quietly does to that number. If your limit doubles, 30% of your limit also doubles. Suddenly, you can carry twice the debt and still look responsible on paper. The rule that was meant to protect you becomes a rule that simply expands alongside the debt it was supposed to prevent. And here's the part that really deserves attention. A limit increase often doesn't just allow more debt. It resets how manageable that debt feels. A $5,000 balance on a $6,000 limit feels tight, almost alarming. That same $5,000 balance on a $20,000 limit feels almost like nothing. Same debt, same interest, same monthly drain on your income. But your brain reads it as progress, simply because the ceiling moved. That false sense of relief is often exactly when repayment momentum quietly stalls. This next part is where things get a little unsettling. Not because it's secret, but because most people have never stopped to think about how sophisticated it's become. Modern banking systems don't just look at your balance and your payment history. They watch patterns, spending velocity, category shifts, the rhythm of your transactions across the month. And increasingly, that data feeds into models that can predict, with surprising accuracy, when you're most likely to need or want extra room on your card. It's not a coincidence that limit increase offers tend to cluster right before major shopping periods. Holiday seasons, back-to-school stretches, big sale events. The system isn't guessing. It's reading the calendar the same way you are, except it's using your own transaction history to time the offer for maximum likelihood of use. Some lenders go even further, pulling in alternative data, rent payment history, subscription patterns, even how consistently you pay smaller recurring bills. This isn't just about deciding if you're a safe bet. It's about calibrating exactly how much additional debt you can carry while still reliably making a minimum payment. That's the real target. Not zero risk, not maximum debt. A precise, sustainable middle zone where you keep carrying a balance and keep paying interest on it without ever slipping into default. Because here's the uncomfortable truth about how this business actually works. A customer who pays their card off in full every month is, financially speaking, close to worthless to the lender. No interest, no revenue, just processing costs. A customer who never pays and defaults is also a loss. That debt has to be written off. The customer that the entire system is quietly optimized around is the one in the middle. Someone who carries a balance, faithfully pays the minimum, and never quite gets to zero. Not struggling enough to default, not disciplined enough to pay it off, just stable in the wrong direction. Now, there's an irony sitting right in the middle of all this, and it's worth sitting with for a second. To build a strong credit score, you're often told you need available credit, and a decent amount of it. Higher limits, kept mostly unused, can genuinely help your utilization ratio and your score. So the system isn't lying when it frames a limit increase as good for your credit. In a narrow, technical sense, it usually is. But that same higher limit is also the exact mechanism that makes overspending easier and debt spirals larger when they happen. The tool that helps your score and the tool that enables the trap are the same tool. There's no separate villain account causing the damage. It's the identical credit line, just used two different ways. This is part of why so many people hesitate to close old, high-limit cards even when they no longer use them. There's a real fear. Closing the account might shrink your total available credit, which could hurt your utilization ratio, which could ding your score. So the accounts stay open. The temptation stays available. And your credit profile becomes quietly dependent on institutions whose interests aren't fully aligned with your own. That's not you being financially reckless. That's a genuinely awkward incentive structure that very few people ever have explained to them clearly. So where does that leave you? Not powerless, just better informed. One option some people use is manually requesting a lower limit on cards they know they overuse. It sounds counterintuitive, almost like sabotaging your own credit profile. But for certain spending patterns, it creates something valuable: friction. A forced ceiling that makes overspending require a conscious decision rather than a passive drift. It's not the right move for everyone, and it's worth thinking through how it might affect your utilization ratio first. But for some people, a lower limit is less a restriction and more a guardrail. The bigger shift, though, is less about the mechanics of any single card and more about what you're actually optimizing for. Credit scores are useful. They open doors, mortgages, car loans, sometimes even job applications. But a score is a measurement of how well you play a lending game. It was never a measurement of your actual wealth. Net worth is. Cash flow is. The gap between what you earn and what you spend, and what's actually accumulating on the other side of that gap. That's the number that determines whether you're building something or just servicing something. It's entirely possible to have an excellent credit score and a fragile financial life at the same time. Plenty of people do. That doesn't mean credit is the enemy. Use deliberately, for emergencies, for genuine leverage, for building history without carrying a balance. It's just a tool, and a useful one. The trap isn't the existence of the credit line. The trap is letting the size of that line quietly redraw the line in your own head for what counts as affordable. None of this means banks are evil or that credit itself is a scam. It's simpler than that, and honestly, a little more human. It's a business. Optimize the way businesses get optimized, around what keeps the product in use, not around what's best for the person using it. Those two goals overlap sometimes. They just don't overlap as often as the marketing suggests. The next time that notification shows up, limit increased. Congratulations. You don't have to feel tricked, and you don't have to feel guilty either. You can just notice it for what it is. A number changed. Nothing about your actual financial reality moved with it. What you do next is still entirely yours to decide. That's really the whole shift. Not outrage at the system, just clarity about how it works. Because once you can see the mechanism, it stops quietly working on you in the background, and it starts being just another tool sitting in your hand, waiting for you to decide what it's for. If any part of this made you look at your own credit limit a little differently, let me know down in the comments. I genuinely like to hear it. And if you want more of these deep dives into how everyday financial systems are actually built, stick around. There's a lot more worth uncovering.